Hey people, I welcome you back again. Now we want to be solving activity ratio related questions. We have various activity ratios. We have inventory turnover ratio, trade receivable turnover ratio, trade payables turnover ratio. We have fixed asset turnover ratio, working capital turnover ratio, all that. Okay. And again, I have divided them based on, I've divided the questions based on the ratios. We have a lot of questions from inventory turnover ratio. So, guess we should start doing. What is the formula for inventory turnover ratios? Inventory turnover ratio formula is cost of revenue from operation divided by average inventory. And average inventory is opening stock plus closing stock divided by 2. Am I right, children? Okay, good. If inventory turnover ratio is 5 times, opening inventory is 28,000, closing inventory is 50% more than opening inventory, find out the cost of revenue from operation. So inventory turnover ratio 5 is equal to cost of revenue from operation divided by average inventory. Opening inventory is 28,000 plus closing inventory is 50% more than opening inventory. So it is 28,000 plus 14,000 divided by 2. That will be your average inventory. This is opening stock, this is closing stock. So 28 plus 10, 38 plus 4, 42, 42 plus 8, 50 plus 20, 70. 70 divided by 2 is 35,000. 35,000 is our average inventory. 5 into average inventory is our cost of revenue from operation. So 35 into 2 is 70, into 2 is 140 plus 35. 1,75,000 is the correct answer, my dear children. Right. Given that opening inventory is so much, purchase is so much, returns outward is so much. Okay. Closing inventory is so much, then inventory turnover ratio is. Okay. Cost of revenue from operation is not given. Opening stock plus purchases minus closing stock is equal to cost of goods sold. So opening stock is 1,20,000. Cost of goods sold or cost of revenue from operation, same thing. 1,20,000 plus purchases of 9 lakh minus 40,000 return. Closing inventory is 20,000 less than opening inventory. So minus closing inventory 1 lakh is equal to cost of goods sold. So that would be 1,40,000. 20 pochna 1,20,000 minus 1,40,000 minus 20. 9 lakh minus 20 on the 8,80,000 is the cost of revenue from operation. Average inventory is opening stock plus closing stock divided by 2. Opening stock in this question is 1,20,000. Closing stock is 1 lakh as given in the question, divided by 2 is 2,20,000 divided by 2, which is 1,10,000. 1,10,000. I didn't have a lot of hope when I got 8,80,000, but when I got 1,10,000 as a denominator, I knew I was getting the correct answer as 8 times. All right, children. Moving forward, given below are the 2 statements as one labeled as assertion reason. A low inventory turnover ratio is not good for the firm. A low inventory turnover ratio. See, inventory turnover ratio, the number of times inventory reach the company's godowns and get exhausted completely. How many times it comes in, completely becomes 0, again comes in, completely becomes 0. So basically, number of times you are purchasing the inventory. I know on a broader level, this is what inventory turnover ratio is. How many times you're exhausting the inventory. So if you're exhausting the inventory very often, it means that you are actually purchasing too many times. Instead, why don't you just purchase in large quantity for fewer times? Because every time you purchase, you have to pay freight inward, the cost relating to purchase. If the inventory turnover ratio is too high, it means you're purchasing, yeah, too high means too many times. Too low means you're purchasing in bulk, a huge amount of stock you're purchasing in bulk, and you're taking time to exhaust that stock. Now, when that happens, the problem is in your godown, you have a lot of inventory locked in your godown, and all of that inventory, all the money that you've spent on that inventory is also locked in the asset called inventory. So you have that interest cost. Also, when you have large amounts of inventory, the storage cost also goes up. So that also contributes. So neither low inventory nor high inventory is good for an organization. Optimum level of inventory is good. And the optimum level sometimes is determined by the size of the organization also. The size of the organization is huge. Um, Somewhere in between is good, not too high or not too low. The size of organization is very small, and you might be purchasing every day, which is all right for the business. So it's optimum. It depends on the business. All right. Now, a low inventory turnover ratio is not good for the firm. A very low ratio and a very high ratio is not good. Low ratio means what? You're purchasing less number of times, which means your storage cost is increasing and the money locked in your inventory is also high. Low ratio shows over trading and may result in shortage of working capital. Low inventory turnover ratio is not good for the firm. Assertion is true. Low ratio doesn't mean you're over trading. You're buying the inventory and kept it. You're not selling it. You're not selling it too much. Okay. You're not exhausting the inventory enough. Okay. So you're not over trading. You're under trading. The reason is wrong. Assertion is only correct. C is the correct answer, my dear children. Fourth one. The dash may indicate that the firm has experienced stockouts and losses. Inventory turnover ratio will tell you. Opening inventory of the firm is 80,000, cost of revenue 6 lakh, inventory turnover ratio 5 times, closing inventory will be, okay. 5 is equal to cost of revenue from operation 6 lakh divided by average inventory. Average inventory is equal to 1,20,000. This comes here, this goes there. So 1,20,000. Opening inventory 80,000 plus closing inventory X divided by 2 is 1,20,000. That is average inventory. So X is equal to 2,40,000 minus 80,000, which will give you 1,60,000. So 1,60,000 is the correct answer, my dear children. Inventory turnover ratio is cost of revenue from operation divided by average inventory. It's an insult if I solve this question. The dash measures the activity of the firm's inventory. Activity ratios measure the activity of particular things. So inventory turnover ratio. Eighth question, revenue from operation is 2 lakh, inventory turnover ratio is 5, gross profit 25%, find out the closing inventory. Closing inventory is 8,000 more than the opening inventory. All right, good. They're saying gross profit ratio is 25%. So 2 lakh la 25% is your profit. So that will be like 550 followed by 3 zeros. 50,000 is your profit. So 1,50,000 is the cost of revenue from operation. Why I found out cost of revenue from operation? Because inventory turnover ratio is equal to cost of revenue from operation divided by average inventory. So average inventory is equal to 1,50,000 divided by 5, which is 30,000. And they're asking for closing inventory. So 30,000 average inventory is equal to opening inventory plus, or closing inventory plus, closing inventory is 8,000 more than opening inventory, minus 8,000. So opening inventory will be closing inventory minus 8,000 divided by 2. 60,000, 68,000 is equal to 2x. X is equal to 34,000. This is maths, you guys solve it. Okay? 34,000 is the correct answer. All right. Ninth question, opening inventory of a firm is 80,000. Cost of revenue from operation is 6 lakh. Inventory turnover ratios. Closing inventory. Array, same kind of question, man. Inventory turnover ratio 5 is equal to 6 lakh. Cost of revenue from operation divided by average inventory. Average inventory is equal to 1,20,000. 1,20,000 is equal to opening stock plus closing stock divided by 2. 2,40,000 minus 1,60,000. Already solved. Why did I do it again? I don't know. Okay. 10. When opening stock is 50,000 and closing stock 60,000, net sales is 3 lakh, gross profit 80,000, then stock turnover ratio. This is nice. They've given all absolute numbers, which is good. Net sales is 3 lakh, gross profit is 80,000. So which means your cost of revenue from operation is 2,20,000. Right? So cost of revenue from operation 2,20,000 divided by average inventory 50,000 plus 60,000 divided by 2. Opening stock plus closing stock by 2. So 50,000 plus 60, 1,10,000 divided by 55,000 is equal to inventory turnover ratio. 3 zeros will get cancelled. We'll go 20 times, we'll go 5 times, go 4 times. Answer is C, 4 times. All right, moving forward, my dear children. 11th one. Net revenue from operation 4 lakh, average inventory 50,000, gross loss on sales 25%. Nice. The loss. So 4 lakh is the net revenue from operation. Your loss is 25%. 25 is 4 is 100, followed by 3 zeros. So your loss is 1 lakh rupees. 4 lakh rupees is the sales plus 1 lakh rupees loss. Will give you cost. Will give you cost of 5 lakh. 5 lakh. So average inventory they've given us 50,000. So 5 lakh divided by 50,000 is equal to 10 times. 10 times is the correct answer, my dear children. All right.